So you mentioned, as long as there's a negative interest rate, you're essentially, let's just take an example. Let's say you get a mortgage at 6% and inflation is 8%, right?
Yep.
You're paying 8%, you're paying the 6% per year, but then your debt shrinks by essentially by 8%, right? So that's why you're saying like we're making money and that's then I guess we're assuming that our income is going to go up by 8% per year along with inflation, right? For that to work.
Well, we don't know actually, because we're not concerned about our personal income in that case. When it applies to an income property, we're concerned about the property's income. Okay. So to get paid 2% to borrow, in a sort of simplified example here, let's assume that you could own a property with no insurance and no property taxes and no maintenance expenses. Now, we all know that's impossible, but those expenses aren't really very high. So, it's not a completely out of whack idea to consider that example. If you had a property with no income and no expenses, no insurance, property taxes, or maintenance costs, okay? So you had no income and no expenses, and you could own a property and get a mortgage. If you could borrow at 6% and inflation was 8%, you would be getting paid 2% to borrow. Now, the one thing we didn't say yet that it's really important that we say is that the real inflation rate is much higher than the stated inflation rate. The consumer price index, the most widely used measure for inflation, is a complete scam. It's totally manipulated in three major ways: weighting, substitution, and what's called hedonic indexing. Okay, and I can go into that if you want, but suffice it to say it's manipulated. I believe that the real inflation rate is about 15 to 17%. Now, why is there debate about this? Because everybody has their own personal inflation rate because we all spend it differently. Okay. But I would say for most people, the real inflation rate is about 15 to 17% in real life. But let's just go with the government's manipulated down number and call it 8%. Okay. So you would make 2%. You would get paid 2% to borrow in the example I gave you. Now, in real life, though, the property does have expenses and it also hopefully has income. And usually the income will vastly outweigh the expenses. So this is a pretty incredible deal for the investor because you will typically make much more income than you have in expenses. And so you will not only make money on inflation-induced debt destruction, the negative interest rate, getting paid to borrow, but you'll also make money on the positive cash flow, the tax benefits, the leverage, all of the other benefits of income property.
Right. So essentially what you're saying is, yes, mortgage rates have gone up, but it's still a good time to get a mortgage and invest into real estate, even at the current prices.
Well, that depends. and what does it depend on? Well, it depends on many things. It depends on, number one, do you have a property that can produce income? Okay, that's the first thing. And number two, what type of real estate market are you investing in? If there are three major types of markets that I've been talking about for the last 18 years: linear markets, cyclical markets, and hybrid markets. And they all act very differently. For example, in a country as large and diverse as the United States, there is no such thing as a national real estate market. We all hear the sound bites on TV or, on a podcast or the radio or whatever, where they talk about the housing market. Well, I don't know what the housing market is. I don't know what that means. Does that mean Los Angeles, Miami, Seattle? Does it mean Memphis, Kansas City, Dallas, or Austin? It simply is not a thing. There is no national housing market. You just can't say that. Now, in a really small country, like I remember my first trip back to Europe as an adult, rented a car and drove all around Europe on that trip, drove about 3,000 miles on that trip. And I remember one day, myself and my friend drove through Luxembourg, an entire country. And it didn't take very long because it's a small country. Now, Luxembourg has a national housing market. The United States does not. Okay. The United States is just too big and too diverse to have a national housing market. So cyclical markets are the markets that get all the attention. There are the expensive Northeastern markets, Washington, D.C., New York, Boston, et cetera. The expensive South Florida markets where I live, Miami, I live in Palm Beach, just north of that. So this is all cyclical. There are the expensive West Coast markets, San Diego, LA, San Francisco, although San Francisco's had some different problems of late, but still a cyclical market, Seattle, et cetera, right? Those are cyclical markets. These are the high flying markets that get all the attention. But the vast majority of the country is a linear market. These are just boring markets that have really good cash flow. They don't have big ups and downs in prices, and they're the best markets in which to invest. And we've been helping investors invest in these markets for 18 years now. So there is a big difference between those markets. The cyclical markets are still, they've been feeling a lot of pain, and they've got more to come, in my opinion. They are going to continue to suffer. But there are many ways to slice and dice the real estate market, right? Not only linear, cyclical, or hybrid market, but price segment within that market, right? So are you buying, in the high end market? Are you buying in the middle? Are you buying below the median price in a given market? What product type are you buying? Single family? Are you buying new single family, old single family? Are you buying condos? Like there's a lot of different things to consider, of course, right? But linear, cyclical, and hybrid, understanding those three major markets is a really good start.